Hey traders, this is Ron Haidt at Market Tamer. Happy Sunday. Hope you're having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. We'll kick off here with the Diamond, which is the Dow ETF. It's the best performing right now. It's holding up the best. The Dow was down on Friday. Volume was big again, but it came off the lows, and it's holding on to the 20-day EMA in red. We can still see higher highs, higher lows, higher highs, higher lows. Now, if we get below the red line, the next target would be the institutional moving average at the 50-day SMA, which is ballpark right now around 259. So it would be the equivalent of about 400 or 500 Dow points down into that area. This is going to slowly come up, inch up day by day. So the diamonds look the best. Now, if we transition into the S&P ETF, the spiders, which I have a bullish position in, if I zoom in here, you can still see the channel in brown. It's still there, still doing just fine. We did bounce off the orange line. Again, 50-day institutional moving average. Volume was above average again today, but Friday, a little higher than Thursday. As long as we hold the 50-day, the trend remains in place. We break the 50-day, a yellow flag goes up. And then I want to watch this trend line because 50-day falls, major yellow flag. The trend line falls, red flag, then the target is the 200-day, and maybe October does lead us into a more of a correction or finally a pullback. Personally, I'd be rooting for a pullback. That'd be nice to set us up for a nice holiday season rally. Taking a look at the Qs. Now here we have a bit of an issue. The broader trading range is in place, but I'm going to get rid of that and zoom in and show you what happened on Friday. We had an increase in volume. We opened just above the 50-day in orange. We closed well below it, off the lows though. As of right now, the best the bulls can do is to basically put in a bit of a double top from the end of August, early September, and then the end of September, early October, a month apart. The last swing low is around 175. That would be the target right now. So we could say this is entering into a sideways trading range. But the one thing I can't do from a technical perspective is still say on the daily chart over the past couple months, it's still bullish. It has to go neutral with the close below the 50-day. We've been using the 50-day as support June, July, August, September, a bunch of times, even Thursday. Now there's a breach. So this goes on the daily, looking out just a couple months, neutral. Very, very short term, you have a 5 and a 20-day crossover. 5 days in blue, 20 days in red. That's a mini sell signal. Close below the 50-day, mini sell signal. Spike in volume, 2 days in a row. Big yellow flags. So caution on the Qs right now. If we go to the IWM and the mid caps, these guys have been performing the worst. So the IWM is the Russell 2000 ETF, small caps. We're coming down and almost at the 200-day SMA in purple. That's another major institutional moving average. So the purple line's around 160. We closed at 162. We're $2 lousy from hitting that. Volume for the 5 past days, the reds are beating the blacks, more selling volume than buying volume. If we come in here to 160, it's just below the previous swing low, but it might be close enough for horseshoes, so to speak. If it breaks the 200-day, that would be a bad sign for this stock. Probably bad for the market as well. The mid caps, the MDY, 200-day closed at around 353-ish. We're at 357, $4 more until we get there. The volume here on the MDY, though, it's not as high as the other indexes. The Qs we saw, huge volume. The others, above average. MDY the least. So right now, there doesn't seem to be a whole lot of massive, heavy selling. But again, 200 days the target. It does tie in with the June low. If that falls, then you're coming back down to previous swing lows in the low to mid, or I should say mid 330s, 335-ish, something like that. And if we take a look at the VIX, $VIX, this was the last spike, which was in February. We got above 35. If I zoom in now, you just see a massive high wave doji. That just says super indecision on Friday. The bears thought they had a chance, got above 17. That's noteworthy. Then it was back below 12. It was all over the place. So if I'm looking at this from a neutral perspective, the bears had a chance to sink the market. They didn't do it. And it was into a weekend. That tells me the bulls have a little more confidence in the bears right now because the VIX didn't surge. In fact, the VIX still finished below 15. Not exactly being confidently bearish, right? So the bulls here, overall in the broad market, they still get the edge going into year end, but some of these daily charts are starting to turn, with the Qs turning the quickest. We'll keep an eye on SPY and DIA heading into Monday and Tuesday with those videos. I did get a question on JD. Oh, before I do that, remember, earnings season. This week we're going to have a few reports. Next week we really start opening up the spigot, so to speak. Be prepared. Make sure you're looking at stocks and saying, hey, could they use protective puts? What happened in the past? Paper trade them. See the value of these protective puts. I'm not a licensed financial advisor. I can't tell you what to do. I never would. But you've seen stocks in the past have an earnings report gap down tremendously, and those protective puts could have saved some massive capital potentially. So start playing around, start practicing, go back and look. You can do back testing. I think protective puts can be wonderful tools to save a lot of heartache and capital loss if the company would have a bad report. All right, that was the public service announcement. Now, I had a question on JD from a viewer, and from an educational perspective and a technical perspective. So this is JD.com. Stocks had a really rough year, putting in a high of almost $50 back in January. Now it's been haircut in half, 50%, and it's really getting hammered since the last earnings report in August from 35 to 23. I actually have to bring in all the data, and even if I do this to a weekly basis, you'll see the lows. $20 is the target. This thing is so bearish, it still has 10+% downside. Not exactly maybe good news, but that's where it would start to come in. I mean, you could make an argument and say there were some lows at 22.50. That's still $1.10 or so lower, 3-4% lower. But I would say 20 would be the multi-year lows and arguably the all-time lows on JD. All right, now let's get into some other stuff here. How about this ETF, the home builders? This is XHB. We are down, count them, 3, 6, 9, 12, 13 days in a row. Friday the 13th. Wow. This thing is getting, beaten up pretty good. Volume's not horrific, but it cannot catch a bid. I'd have to go back to a 5-year chart and show you there was a low actually last year around the 21st of August. That's where we stopped today. But if that 200 period moving average on the weekly chart fails, the next one's down around 20% lower. So heads up on XHB. It is definitely bearish. We did have a bit of a hammer, or we did have a hammer form on Friday, but the spike in volume wasn't there. If there would have been a huge spike in volume, I could say, hey, this might be the capitulation day. 13th day was the charm. As of right now, the volume is not confirming that, so I have no confidence that could be a true bottoming hammer. Here's Amazon. A high on the 4th of September and a high on the 1st of October. Now we have a trading range. Much more below today's low. You go back to each swing low, just under 1,800, or down just below 1,700, which is where the 200-day comes in purple. If the market's going to sell off this week, that would be the target for Amazon, the high-profile target down near the 200-day. Currently, you are clinging to a trading range. See that? You are just clinging, and clinging. If I zoom this over, see it a little better, drop it, you're right there, right? If I take it out, you can see we've now had 2 straight days below the 50-day. This is yellow flag worthy. If I was trading Amazon and I had shares, I'd want to consider a protective put right now. The stock's had an amazing run, up 100% for the year. Why not consider preparing for that later in the month earnings report? And the NASDAQ's not looking good. The other markets are starting to follow suit. To me, it's not a bad time to think of potential collar trade if I had shares, or even a protective put strategy. Here's BHF. Try that again. This is Bright House. Stock was up around mid-upper 60s, then it's down to 40. We've now finally put in a higher high, now a higher low, and now we're pushing higher. There is no massive consolidation. There's a little bit in the low to mid-50s, 10-15% higher. Then the target's back up here. My point is, this stock has undergone a very prolonged downtrend pretty much all year. Now you're putting in higher highs, higher lows. That's a sign the trend or the sentiment is changing. Here's Brazil. We have a nice W bottom or a double bottom. We're trying to get about 37.50. Not having a whole lot of luck. Then there's the 200-day. Above the 200-day, the target is up in the upper 40s, so 46, 47-ish. Keep an eye on EWZ. Tesla, I continue to get questions and comments about it. This thing is just absolutely crazy to trade from a swing trading perspective. Even holding overnight can be hazardous to your health. Again, you go from 310 to 270 to 310 to 260, 195. This is just ping pong, ants in your pants, bouncing all over the place. It's got to get above the 200-day, then the resistance is up here. Right now, it is just one hot potato. If I had shares, I'd be thinking about collar trades. I'd be thinking about at least a married put. Costco missed earnings, reportedly, below the 50-day, closed at the lows, big volume. The next technical target is down in this consolidation range. You could say 180, 190. However, the 200-day is just above $200. So what you would do is go first 200-day technically, and then 190 to 180. This one is bearish right now. And I commented about Pepsi earlier this week in a video. Earnings miss, we broke support. The next support for Pepsi literally is down there, $95. Not saying it's going to get there. Volume is not that bad. It's not that high. It's just barely above average, in my opinion, giving it a quick look. But there's no structural support for another $10+. So unless there's going to be news to turn it around, that's a target right now. And, I like to consider protective puts on stocks I own if it's a larger piece of the portfolio. So if Pepsi would have been a larger piece of the portfolio, I would have had some protective puts, and now I just hold them and let them drop. Typically what I would do, again, always from an educational perspective, 45 to 90 days in time, and they're typically purchased right near the money, just as an approximate. So if the stock's at 110, it's 110 long put. And if it would be from today, it would at least be January, if not February options, something like that. All right. Hope that you find this helpful. I wish you guys a fantastic week ahead. I look forward to seeing you in the next video. Take good care.